Live from New York City for our audience worldwide this morning. Good morning, good morning. Equities just a little bit lower, your 10-year yield just a little bit higher. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open with Jonathan Ferro.
Live from New York City, we begin with the big issue, setting the stage for May.
The Fed governors are speaking more hawkishly.
The comments we've heard from Brainerd and others over the last week or so.
The Fed minutes 50 basis point rate hikes are, in fact, on the table.
They are likely to go 50 basis points in May.
And more than one of them is, in fact, possible.
The market is welcoming these 50 basis point hikes.
The FOMC meeting on May 4th.
The May 4th meeting.
They need to raise rates. And they need to start cutting down on the size of the balance sheet.
It's certainly not an easy position for the Fed.
They're throwing the kitchen sink at forward guidance here.
Trying to re-anchor those inflation expectations.
They're trying so hard to get this soft landing and retain inflation credibility.
This job of orchestrating a soft landing is going to be difficult.
Joining us now to discuss is PIMCO's Geraldine, Sundstrom and Allspring's George Bory. Geraldine, let's begin with you. Your expectations and what you believe at PIMCO this Fed is facing. You guys call it the anti-Goldilocks. Walk us through it.
Well, like in Goldilocks, the temperatures are not quite right. Inflation is too hot and the growth is getting too cold. That really is the sort of cross that the Fed has to face. Of course, we're starting with growth that's been pretty robust so far, but certain leading indicator are certainly pointing downward. I mean, the Fed probably has a better job than the ECB, where there, of course, growth is falling more substantially.
Expectations sky high. This from Bank of America for the next move from the Fed. They go with a 50 basis point move at the next meeting, the one after that, and the one after that. 25 after all of that at each and every meeting until we get the Fed funds to 325 to 350. The expectations out there at the moment are absolutely humongous. And George Bory, to your view, in your career, have you ever seen the Federal Reserve this hawkish?
Jonathan, I've never, in over 30 years of working in the bond market, I've never seen the Fed as hawkish and as explicitly hawkish as they have been over the last month and a half or so. The pivot started in January, and the Russian invasion of Ukraine just accelerated it. But it seems that the Fed is hell-bent on normalizing rates. And when all the doves become hawks and then the hawks start sort of descending down on markets, it's very clear that kind of a shock and awe strategy is exactly what they're trying to do. They need to normalize, and they need to normalize quickly. They were behind the curve. They are behind the curve. They're using as much verbal guidance as possible to sort of get market expectations up. Fortunately, market expectations are up, but now they need to execute. They need to implement, and markets are still heavily bruised from their actions and their comments over the last several weeks. So our bias is that yields probably still go higher from here.
Well, this is the issue. We've never seen them this hawkish because we've never seen them this dovish. Their policy is so out of whack with the facts on the ground. The FOMC put the minutes out yesterday. I'm sure many of you read them. This is what they had to say. One or more 50 basis point increases in the target range could be appropriate at future meetings. This is what they had to say on balance sheet reduction. Monthly caps of about $60 billion for Treasury securities and about $35 billion for agency MBS would likely be appropriate. Mike McKee, they've got some big plans.
They've got some big plans. This is roughly double what they did back in 2017 to 2019 when they were reducing the balance sheet for the first time. And because this is only the second time they've done it, they can't be sure what the impact is going to be. But as you mentioned, they are going to start with about $95 billion a month. Well, actually phased in over 3 months, but $95 billion a month in treasuries and MBS. And because they won't have that much refunding each month, they will fill in the balance balance with Treasury bills and spend their Treasury bills basically down to zero, because in an ample reserve system that they're using now, they don't need the T-bills as they used to in the past. So what does this mean for the size of the balance sheet? Well, that's the open question. How far do they go? If you look at a plot of what their plans would do, in the end of 2024, you'd end up with just under $6 trillion on the balance sheet. We've got just under $9 trillion right now. Is that going to be enough? Hard to know. Look on the left side there, and you can see the two circles. That's where the balance sheet got to. And then remember, the markets broke. Short-term and repo really struggled, and Jay Powell was forced to reverse himself, and they built the balance sheet back up again until you could see what happened with the pandemic. So how far do they go? They'll probably have to go until they break something. Now, that raises the question, too, of what do you do with mortgages? Because as you can see, the funny thing about the mortgage chart is that it's very lumpy as it gets bigger, and that's because you have prepayment risk. Does the Fed hold on to mortgages for 30 years? Probably not. They're talking about the possibility of selling them, and we don't know what impact that's going to have on the mortgage market either. So we have some answers as to what they're planning, but we don't quite know what we're going to get out of it, John.
Some massive plans. Mike McKee, thank you. Great lineup this morning. We get lucky. Joining us now is Chris Harvey of Wells Fargo. Chris, let's talk about it. Can you take any comfort from the plans being laid out by this Federal Reserve?
Can I take any comfort? Listen, what the Fed is going to do, the Fed's just going to follow the instructions of the market. The market has told them to get more hawkish. They're getting more hawkish. I think as far as the balance sheet, one of the things, and this is my little pet peeve, we're going to look back over the years, academics, investors, everyone else, and we're going to scratch our heads and say, why did the Fed ever continue to buy bonds in June, July, August, September, so on and so forth? It made no sense at that point in time. And what they're doing is it's a tacit agreement with that belief. We made a mistake. We have to reverse that mistake, and we're doing it as quickly as we can. The other thing I want to talk about is many investors are focused on Fed rate hikes. They're focused on the balance sheet. But one thing I think people don't focus on enough, and is very important, is the fact that you've taken $1 trillion buyer out of the marketplace. If you look at when the Fed officially ended buying bonds, it was about March 9th of this year. If you look at 10-year nominals, 10-year reals, they started to walk higher at that point in time. The person who's stepping in for that $1 trillion buyer is a lot more price sensitive. And what we're seeing is just a normalization of interest rates, as we should have seen a long time ago.
Geraldine, one thing that a lot of people are saying, and Mike McKee just said it, is that the Fed will keep going until something breaks. Are you and the team at PIMCO concerned about a repeat of Q4 2018?
Well, I think for now they need to deliver and be hard, at least until we see the peak of inflation, which could happen sometime in the summer. At what point it will be up to them to decide if they want to slow down the pace and try to soft land the ship, which most probably is their intention. I don't think it's their intention to break something along the way. That said, the path to manage landing inflation without breaking growth is getting narrower and narrower.
George Bory, your thoughts on that? A repeat of Q4 2018, and to be more specific, December 2018.
Yeah, it's they need, as Chris said, they need to normalize. They need to normalize as quickly as possible. And I think when we look at the fixed income market actually has it about right. We're very fixated on the curve and the shape of the curve. The curve is basically flat. And that's telling us that the Fed is moving, very aggressively, and it's very difficult to take a meaningful directional move on the curve. And so when you sort of look, 2 years out to 30, we're very, very flat, and we think that's actually going to persist for quite some time. The Fed has the window right now to start to move policy up to sort of normalize the very front end of the curve, and then it will really come down to the economics and basically the trajectory of inflation. We still have negative real yields, and we think we're going to get positive real yields over the course of this year. And with, sort of inflation still running hot, and as we just mentioned, not likely to peak until probably this summer, that means yields continue to push higher. Now, we know higher yields tend to break things from an economic perspective, and we are going to see a slowdown in growth. The big question is, does it morph into a recession?
Yeah.
It seems unlikely that we're going to be able to avoid a harder landing. The question is sort of when. Is it in 6 months? Is it in 12 months? Or is it much further out? Bond market's telling you right now it's not the next 12 months. But that could come forward if things start to break more quickly than we expect.
I wonder if equities are starting to position for that. And Chris, we'll talk about this through the opening bell a little bit later, you and I. But are you starting to see that defensive bias creep in a bigger way? The home builders softer, the transport softer, yields are up, but the banks haven't been performing. Chris, what's your interpretation of the price action?
Yeah, the price action is more defensive. You're seeing utilities outperform. You're seeing staples outperform. You're seeing cyclicals more recently as talk of recession beginning to underperform. I think banks have underperformed double digits since the end of February. But at the end of the day, we think recession, similar to what George was saying, we think it's a little bit premature to talk about recession. Economic malaise, economic slowdown, yes. We're going to have a recession, and you're right. I think you hit it. I think Michael hit it right on the head. If the Fed breaks something, we're going to have a recession. So when we look at inflation, there's inflation caused by geopolitical, and there's inflation caused by more the day-to-day economics. If they try and fight the inflation that's more geopolitical driven, in all likelihood, things are going to break. And what I worry about is, does this Fed, at some point in time, does the Fed say, we don't want to be the Fed known as the ones letting inflation back in, and they get too hawkish? Again, this is to be decided. But to your point, we are seeing the markets react. I do think it's a little bit premature, but we'll see how things play out as we go forward in time.
Great lineup this morning. Chris Harvey, George Bory and Geraldine Sundstrom sticking with us. Futures are just slightly negative, down 0.25% on the S&P, with your movers going into the open 20 minutes away. Here's Abby.
Good morning, John. And lots of idiosyncratic stock movers to take a look at this morning, starting out with the shares of HP soaring on the news that Warren Buffett's Berkshire Hathaway has taken a $4.2 billion stake in HP, reinforces the computer maker's long-term capital returns value story, that according to Bloomberg Intelligence. Occidental, another Buffett-endorsed stock, raised at Piper Sandler to overweight, the analyst saying it is relatively inexpensive. To the downside, though, Ford cut at Barclays to a negative. The company, the bank, sees more risk to autos, despite the recent sell-off in Ford. Analysts there are saying that inflation, production pressures, and consumer weakness all a concern for Ford. And then finally, Wayfair also cut at Wells Fargo to an underweight. The bank is turning more cautious on home-related stocks. And John, to your point, having everything to do with the weakness that we're seeing in the housing sector.
A ton of weakness there. Not in the data yet in a big way, but certainly in the stocks in the equity market. Abby, thank you. Coming up, lawmakers grilling oil executives on Capitol Hill.
We have no tolerance for price gouging.
The reality is that during this crisis, you've had record profits and stock buybacks.
That conversation up next.
We've got a pandemic, and we've got Putin, and you are using these crises to gouge the American people.
We have no tolerance for price gouging.
The reality is that during this crisis, you've had record profits and stock buybacks.
We think we can return value to our shareholders, as well as increase production, as well as invest for the future in renewables, low and no carbon fuels for our customers. We will be doing all of that.
Congressman, mixed messages from the government do not encourage us to make investments with confidence in future supply.
This went about as well as you'd expect it to go. Energy executives facing a grilling on Capitol Hill, given surging prices. DC has some questions. Shell has some answers. Things are going to get more expensive for them. They came out with a monster write-down today, reflecting the unprecedented volatility in commodity prices prevailing up to the end of the quarter. Material additional movements could be seen in cash flow from operations. They're saying that withdrawal from Russia could cost them anywhere between $4 to $5 billion. Anne-Marie joins us now down in D.C. And AMH, the Europeans might be able to hide behind some Russia write-downs for this quarter. The American producers won't be able to. How controversial will those profits for Q1 be?
Oh, they're going to be very controversial, Jonathan. Already we have a signal from Exxon that their first quarter might be $13 or $11 billion. It's the highest in 13 years. So quite an awkward moment to get this grilling on Capitol Hill. And 6 hours of it, Jonathan, and as you said, it went as well as you can expect, right? You have the Democrats on one hand saying that they are price gouging, and then you have Republicans who also want to make the point and point the finger using the oil executives that this is actually the policies of the Biden administration. Whichever way you look at it, the issue is going into the midterm elections, this is a massive problem for politicians as they deal with constituents because gas prices are higher, they are not coming down, and already the polls show that inflation is a huge concern for Americans.
MH, let's talk about policy then. We know about the SPR release. Jeff Curry at Goldman Sachs has pushed back against that. He says he thinks it will be counterproductive. What's the next step? Here's the one.
Well, it's difficult, right? Because there's only so much of these resources in the world right now. What you heard from executives yesterday is that they want to, and they are going to increase CapEx to try to get more production online. This comes, though, as the executives explained yesterday, after an incredible year where we saw oil go negative, absolutely decimated in terms of the fuel demand, and then at the same time, other companies forcing to leave business because of how bad that pandemic was. Now they're coming back, and they've been forced to give that money back to shareholders, and they're not investing. They're saying that they will invest. So the Biden administration says this SPR release, this epic SPR release, also alongside other IEA partners, is a gap to get there. But the issue is that Russia right now is a massive commodity player, and every day, Jonathan, the talk ratchets it up in Europe that potentially they might start shunning Russian oil, and that is just going to be a higher premium on the price.
We'll catch up with you a little bit later on that with Maria Tadeo as well. Anne-Marie down in D.C. As Prime Minister Mario Draghi of Italy said recently, what do you want, peace or air conditioning in the summer? We'll pick up on those comments a little bit later. Dan Yergin, great man, had this to say about energy. Take a listen.
When people go back to as the 1970s as the most severe, I think this potentially is worse because it involves not only oil, but it involves natural gas, involves coal, and it involves two countries that happen to be the nuclear superpowers. So the risks are as high as they seemed in the 1970s. The risks right now are higher.
Geraldine, the energy issue. Can you walk me through your portfolio and how it's exposed to what's taking place at the moment?
There is the energy, and there's a vast complex of commodities that have seen their price going higher. And, as harvest season arrives, we might see grains going higher. So one way of doing this is to gain exposure to currencies and of countries who are exporting those critical material, be it energy, metals, or grains. So we have a positive attitude towards those currencies, and it makes sense to have this in the portfolio, all the more than as it happened, even though those countries have positive terms of trade, the central banks have also been hiking interest rates, in particular in emerging markets, so the carry is very attractive.
How much trouble are the importers in?
It goes and depends. For certain, some part of Asia and Europe are in a not so good position, and we've seen some trade deficits starting to print at record level already for the Eurozone. This is probably something that is going to carry on. So this makes those currency good fundings.
George, you said this. The world has certainly been turned upside down as we find DM behind the curve and in some cases EM ahead of the curve. Is that a factor in your thinking around EM right now?
It certainly is, Jonathan. I mean, if you look at Brazil is deep into their monetary tightening policy, and so we see several countries, sort of emerging market companies in particular, which were already starting to fight sort of high inflationary measures. So they're sort of still susceptible to some of the price challenges that many other countries are finding, but their policy is well ahead of where the developed world is. Now, in addition to that, big commodity exporters, find themselves in a positive position to be able to sort of meet the demand that's that's been created by Russia effectively being boxed out of the international markets. And so, there's a major rotation going on pretty much across, sort of the global commodity landscape, and also across sort of fixed income. The fixed income markets are trying to calibrate themselves to these shifts. So we do see some opportunities in emerging markets, particularly on the bond side and on the corporate side, and for companies that sit within countries that are well ahead on the rate tightening cycle, and in companies that are well positioned to basically sell into the demand that has been created by the pivot away from Russia to other countries. So there are some really interesting opportunities that we think become both bond friendly and economic friendly.
Chris, the themes right now in the United States are pretty clear. Energy prices up, food prices up, mortgage costs are going up. What else is going up? Pretty much everything across the board. So, Chris, I want to know from your standpoint the optimal way to think about the U.S. consumer in the equity market today. What is it?
Okay, let's start with the balance sheet of the U.S. consumer. The balance sheet of the U.S. consumer is actually quite strong. What the consumer is doing at this point in time is they're normalizing. We should have expected them to normalize their spending. We are beginning to see that. What they're doing is they're moving away from durables to more service-type situations, to more experiences. They are looking for more value when they go to the supermarket, when they go to the store. We're beginning to see that. There's a trade down into generics from time to time, but this is not a cash and can good type situation. One of the things that we have to go back to is that the individual still is pretty comfortable in his or her job and still believes that their prospects are pretty good. So the U.S. consumer is not in a recession. It's more of we are beginning to normalize things. And let's go back to where oil is. Brent is not at 127. Brent is now between 101 and 103. We could have some issues with refining. I had a long conversation with Roger Reed, our energy analyst, and there's a lot of issues with gasoline, and gasoline prices will go higher. And I think the administration's stance with regard and their relationship with energy isn't a good one. And so you're going to see prices stay elevated for a period of time. But as far as the consumer is still spending, but they're changing around that basket. They're looking for more value. They still have a ton of money, and they're feeling pretty comfortable in their prospects. And so, again, we are going into a normalization. We're going into some sort of economic malaise, but it's way too early to call this a recession.
Chris Harvey sticking with us alongside George and Geraldine. Coming up on the programme, the morning calls, and later, rising bond yields weighing on big tech and doing very little for big banks. Their conversation up next. 5 minutes away from the opening bow. Futures just a little bit lower, softer, negative by 0.2%. That's the price action here at the morning calls. JP Morgan upgrading AutoNation to overweight, highlighting an impressive balance sheet and attractive valuation. Whilst Fargo downgrading Wayfair to underweight, $100 price target, growing increasingly cautious on macro-sensitive retailers. And finally, Barclays downgrading Ford to equal weight, warning that investors are underestimating headwinds from inflationary pressures. There's a theme there, isn't there? Coming up, rising interest rates failing to support the financials, entering the session on a 6-day losing streak. That conversation up shortly. Your opening bell this Thursday morning, just around the corner. 24 seconds away from the opening bell in New York City this morning. Good morning to you all. Here's the Thursday morning price action with negative 0.2% on the S&P. A little bit softer on the Nasdaq as well. On the Nasdaq 100 over the previous 2 days, down by more than 4%. That losing streak starting to build again. There's the opening bell. Switch on the board and get to the bond market. I keep going over this. We closed out last year at 70-something basis points on a 2-year yield in America. What a transformation of this bond market over the last 3 months. Your 2-year now, 245, yields in a couple of basis points there. Yields higher on 10s by 4 or 5 basis points, getting back close to 265 at 264.28. The curve actually a bit steeper again today, getting back close to 20 basis points on 2s, 10s. In the FX market, a euro stronger, dollar weaker, euro dollar 109.30, and in crude, up 0.9% on WTI to about $97 a barrel. That's the early morning price action cross asset into the session 30 seconds in. Here's Abby with your movers.
John, starting out with one of the top stocks on the open and in the pre-market for sure, HP. Warren Buffett's Berkshire Hathaway has taken a $4.2 billion stake in HP, truly a value name, a long-term capital returns value story. Lamb Weston, the $8.8 billion potato products company, they beat estimates. A big supplier to McDonald's and Yum Brands, so some positive read-through there for those companies. Conagra Brands, though, on the other hand, they make Duncan Hines brands, among many others. Soaring inflation has caused that company to lower its full-year guidance, so that company is dealing with rising prices. Investors not liking it. That said, well off of its down 4% pre-market lows. And then Netflix down off of its pre-market lows, too, down about 0.75%. Stifel has trimmed its price target, and Baird is saying that European subscriber growth may fall on, yes, inflation. But of course, John, the big theme in recent days, rates backing up, pressuring these high valuation stocks and sending technology lower.
And it hasn't helped the banks. Abby, thank you. That's what I want to talk about right now. Coming into today, the Kbw Banks Index has been down for 6 straight sessions. Over the last 7 days, we're unchanged today. So over the last 7, we're down by almost 9 percentage points. Kaylee Lyon's taking a look at this. Hey, Kaylee.
Hey, John. Well, that's extending the largest losing streak we've seen, the longest streak since January of 2021. And this index now at its lowest since July of last year. And the weird thing, as you allude to, that has happened over a same stretch of time in which the 10-year yield has risen about 25 basis points or so. Usually when yields go up, banks go up. When they go down, banks go down in tandem. Those two lines have tracked each other so well for so long. But now we are seeing a serious reversal, those going in completely opposite directions. And it's not just that bank stocks are heading lower, they're actually performing the broader equity market. Since that March rally began, the late March rally back on March 14th, the banks have been the worst level 2 S&P 500 industry group, falling about 3% over that time. And John, the question is why, especially when we've seen the prospect of more aggressive rate hikes coming from the Federal Reserve, which in theory should help the banks on net interest income. It likely boils down to the theory that the Fed is actually going to be too aggressive, at least slowing the economy, potentially causing a recession. And that will ultimately end up hurting demand for loans and the fundamental picture for these companies. Speaking of the fundamental picture, bank earnings, of course, are coming right around the corner. JP Morgan kicking things off next Wednesday with its first report for 2022. And the fact is, John, 2022 not expected to be as great a year as last year was when it comes to net income. Net income estimates across the 6 big banks seen falling by more than $44 billion collectively, down about 28% from last year's record, John.
Kelly, thank you. JP Morgan kicking things off next week. We've gone over this a few times already this morning. This equity market's getting interesting. Even with a kick higher in rates, we're expecting some big moves from the Federal Reserve. The banks aren't delivering big returns. They're underperforming. The staples, the utilities, the more defensive parts of this market are starting to pick up, particularly the utilities over the last couple of days. You've seen the weakness in the home builders over the last year. You've seen the weakness in the transports more recently. Everybody's been talking about that. So what do? Run for the hills, find a rock, get a tin hat, or do you buy the weakness? UBS thinks maybe you do the latter. They say this. They like the value sectors such as energy and financials. They tend to outperform in a period of rising rates. We maintain a preference for US value, which is less impacted by high yields and should benefit from relatively solid US economic growth. I want to come to you on this, Chris, and start with the banks, because I know you're looking for a bounce through earnings season. Walk me through it.
Yeah, so, John, you may not get this reference, but banks are the kind of George Costanza of the financials, of the equity space. Typically, when banks outperform coming into earnings, they underperform, and vice versa. We've seen this over a 5-day window, a 1-month window, and what we expect is they're underperforming. Why? Because we're talking about recession. If we're talking about recession, we're talking about credit. If credit goes bad, that's a problem. The other thing that we're also talking about is deposit betas. People think that deposit betas may be too high and deposits could move as interest rates go higher. At the end of the day, we don't think the underlying fundamentals are going to be as bad as feared. We don't think guidance will be as bad as feared. And what we're going to see is a relief rally for the banks. We think you're going to see a pop in the short term. If you're very negative on the banks, okay, fine, right? Then take this as an opportunity to reposition. We wouldn't tell you that. We think there's more growth. We think there's more opportunity. We think the fundamentals are still good and the recession's not coming tomorrow, or at least until the end of the year, if not later. And you can still make money in the banks. And so at the end of the day, what we expect to see right here, right now, is once we go where they're going to trade down into the print, once we get that print probably is not as bad as expected. We'll see a bit of a relief rally. We think they continue to go higher. But at the end of the day, we believe you're going to get some sort of short-term pop.
Was that a Seinfeld reference?
It was a Seinfeld
Okay,
reference,
just to
yes.
confirm. Just, you know, we have an audience outside of the US as well, just to throw
Yes.
that out there. Geraldine, to bring you into the conversation, the weakness that Chris and I are talking about in the more economically sensitive parts of the equity market, any reason to lean into these sectors to buy this weakness?
Well, we think that we're late in the economic expansion, so our tendency would be to go for quality as opposed to value, which tend to do poorly late in the cycle. And when it comes to banks, there are also factors like cost pressures, which have been quite important. The capital market activity is going to see a big drop. And therefore, we prefer to, when we invest in banks, do it via credit as opposed to equities.
Can you build out on that as well, George? Credit versus equity when it comes to the financials?
Yeah, I mean, when you think about credit, you know, as a bondholder, you know, what we're looking for is stability and certainty of coupon payments and cash flows. And from that perspective, the banks are still in pretty good shape. But the important thing to remember is banks, you know, make money, you know, not only on the level of yields, but the shape of the curve. So a flat curve for an extended period of time just makes for heavy sledding, and it's not surprising that the banks are underperforming. The more important question is just credit quality and credit in general. You know, corporate credit has had a tremendous run over the last few years, and certainly all the intervention back in 2020 materially improved the corporate credit backdrop and just credit conditions in general. So as the Fed steps back, you know, to expect credit to sort of improve from here is probably a meaningful assumption. I think the reality is that credit conditions are have tightened up, or likely to continue to tighten up, and credit quality is going to start to erode. Now, pace matters. And the reality is that it's not going to unravel very quickly, but over time, higher rates, flatter curves, and a more tough operating environment means that credit quality is going to start to deteriorate. So when we think about credit and credit in portfolios, we want to move up in quality. That's the simple message. And from a value versus growth perspective, we do like value. We want companies that are going to be certain in terms of their payment, and we also like kind of the fastest pace of cash flow possible. So when we think about the securities of those companies, we want to be shorter duration. We want as much cash flow coming to us as quickly as possible so that we can reinvest it as rates rise. So it's really kind of a multi-pronged strategy, but one that sort of, you know, harbors both, you know, sort of the economic backdrop and the technicals that really sit within fixed income.
George, would you be willing to suggest that we should also be building up a cash position, given what's happening around us at the moment?
You know, yes, I think cash is becoming an important commodity. You know, as rates start to rise, you should start to see kind of cash balances, you know, increase. And if cash rates are going to be at, let's call it 2.5%, you know, 2 years out, that's not a terrible position. Now, the reality is that's dry powder, and there are substantial, you know, sort of pools of dry powder already in existence. So this is sort of an incremental add to what are already substantial cash positions that seem to be, you know, pretty well anchored in the markets. Now, some of that cash is getting absorbed by inflation and people needing to pay more for things. But from an investment perspective, holding a little bit more cash right now, we think makes some sense. And we would want to look to deploy that as we move forward.
And Chris, I wanted to give you the final word on big tech. We caught up with Dan Ives of Wedbush a little bit earlier this morning. The bull is bullish, believe it or not. He said this: rate news is baked in. Now it's time to aggressively own tech. The sector is as oversold as we've seen since 2015. We'd be buying cloud, software, cyber, security, chips, FANGs, Apple, take your pick. I mean, that line, as oversold as we've seen it since 2015. When I look at some of these names, Chris, I wouldn't call it oversold, would you?
No, I wouldn't call it oversold, but what I would tell you is in our model portfolio, we have a signature picks portfolio. Earlier this year, we did pick up some secular growth stories. We picked up NVIDIA, we picked up Nextera, we picked up Danaher, all when they were down 20, 25, 30% from their recent highs. Now that we've popped, what we're beginning to see, and with the R word being bandied about, in that portfolio, we're starting to shift back to picking up more secular and value stories. This week, we picked up a Bath and Body Works. And so we're being very tactical. We're being very opportunistic. And at the end of the day, we are going to go into some sort of stagflationary environment. Ultimately, that's probably going to be pretty good for growth. But we think at this point in time, it's not opportunistic. A couple of weeks ago, yes. Right now, not so much.
Chris, appreciate your insight. Just to run us through some of the things you're doing at the moment, alongside George Bory and Geraldine Sundstrom. To Chris, Harvey, and to the two of you, thank you so much. Thank you very much. On stagflation, did you guys see the ECB accounts this morning that came out? This is what the ECB had to say. Given the extremely strong starting point and the anchoring of medium-term inflation expectations, it was difficult to see how this shock could push the Eurozone into stagflation. I'm not going to take a view on whether we go into stagflation or not in the Eurozone. Some people might say it's already happening. I will say this, I struggle to see how it's difficult to see how that would happen. I think for most of you engaging in this programme on a daily basis, you might find it somewhat easy to see how that could be a scenario we end up in. That's the ECB for you. From New York, coming up, the US announcing fresh sanctions against Russia.
Just in 1 year, our sanctions are likely to wipe out the last 15 years of Russia's economic gains.
That conversation up next.
Just in 1 year, our sanctions are likely to wipe out the last 15 years of Russia's economic gains. And because we've cut Russia off from importing technologies like semiconductors and encryption security and critical components of quantum technology that they need to compete in the 21st century, we're going to stifle Russia's ability in its economy to grow for years to come.
Western allies ramping up sanctions against Russia. This is Ukraine's foreign minister pleads for one thing.
My agenda is very simple. It has only 3 items on it. It's weapons, weapons, and weapons. We are confident that the best way to help Ukraine now is to provide it with all necessary to contain Putin and to defeat Russian army in Ukraine, in the territory of Ukraine.
Team coverage starts right now with Bloomberg's Maria Tadeo in Brussels and AMH down in DC. Maria, first to you. Have we come to an agreement in Brussels?
Well, you know, there's 2 things happening here. One, of course, is about the sanctions. There's a whole back and forth on this. Remember, a lot of this has to do with that ban, that winding down of contracts of coal. Now, the thing is, yes, there is back and forth, but the impression that we have is that this is going to be solved today, precisely because the head of the European Commission, Ursula von der Leyen, is going to Ukraine tomorrow to meet with the president of Ukraine, Mr. Zelensky, and she can't go empty-handed. Now, when it comes to the weapons, that is not clear. We just heard from the Ukrainian Foreign Minister Dmytro Kuleba, who said we need these weapons. And it was interesting, the reasons for this. He said at this point, we're not going to see a ceasefire because the 2 sides, Ukraine and Russia, are prepping for the biggest battle we've seen in this war yet. And that is a battle for Donbass. This is in the east of Ukraine. He said whoever wins that battle, we have the strongest hand in the future talks. So again, he repeated that plea. We need weapons, we need tanks, we need planes, and we need heavy artillery, and we need it fast. Now, he said that NATO, of course, is not going to provide this, but he hopes that after this meeting today, countries that are members of NATO will supply it on an individual basis. But to me, what's very striking, he said out loud what we all know and what everyone's thinking, ultimately, a lot of this will come down to that battle for Donbass, and this is going to be the biggest battle we've seen so far in this war by a large margin.
Anne-Marie, they want weapons and they want more sanctions. What's left for the States?
Well, for the United States, there's really not a ton that's left in terms of hitting even harder at Putin and the lifeline of the Russian economy. Jonathan, they can do more, as they done yesterday, in terms of maybe full blocking sanctions on more banks. Of course, those also come with energy carve-outs. They could potentially not have the energy carve-outs. The other thing, Jonathan, of course, really is, it comes down to, is what goes on in Europe. Is the United States going to put pressure on Europe to not stop at coal and go ahead with oil and go ahead with natural gas?
AMH, thank you. Anne-Marie, alongside Maria Tadeo. An important conversation now. Joining us is the Director General of the International Atomic Energy Agency, Rafael Mariano Grossi. Rafael, let's begin with this. You've just had a week-long trip, I understand, to Ukraine and Russia. We have nuclear reactors operating in a war zone. Can you share with us what you've seen, what you've learned, and if there's any reason for immediate concern?
Well, of course, reasons for concern are very clear, and they continue. If anything, we've just heard in the show that this conflict is nowhere near an end. And of course, it's the first time that you have an active war, an ongoing war in a territory that is vast, and it has a very, very developed nuclear infrastructure there. So from the very beginning of it, myself and the IAEA was offering its services to make sure that the nuclear facilities in Ukraine would be safe and secure. And we had problems specifically in two places, one of which has just been freed from the occupation forces, which is the famous facility at Chernobyl, where the famous nuclear accident took place in 1986. And then the biggest reactor in Europe, the biggest nuclear plant in Europe with 6 reactors, actually, Zaporizhia, which is still under Russian control. So there was a lot for me to look at and to discuss. I was visiting another facility, the closest, in fact, to the war zone in the south of the country, not far away from areas between the Donbass, as it was being described, and the south of the country, where you also have an open front. And so we were looking at the nuclear safety and nuclear security situation there, and also talking about what needs to be done in the next few weeks to restore some capabilities that have been lost in Chernobyl, and to look at what may be needed in some of the others. So this is an ongoing work. It's not something that has ended there. I hope to be visiting Chernobyl as soon as possible.
Can we pick out one of the plants, Zaporizhia, if we can start there? It got worldwide attention in the last month for all the wrong reasons, as you know. Have you been in contact with the staff there? Can you give me some insight into their working conditions and any reason to believe their well-being could impact the safety of that operation?
Well, you have this very peculiar, unique situation where you have the plant itself is being operated by the normal rightful operators, the Ukrainian staff. But at the same time, you have security forces that are controlling the perimeter and in fact, the main activities on site. We are in constant contact with the Ukrainian authorities, the Ukrainian nuclear regulator, and the staff as well through our emergency center here at the IAEA, which is the one that is producing every day. You may have seen those updates on what is the situation. So we're in contact with them. We know, and I was reporting this yesterday, we know that the situation, the morale of the staff is very low. They feel the pressure. It's been a long time. And you may remember that on the night from from March 3rd to 4th, there was a violent episode inside the site where an adjacent building to one of the reactors was under fire, and there was a fire after that, which had to be contained. So there's been a lot of stress. This continues, and it's not sustainable like this. So this is also something that I was discussing in my trip to Ukraine, and trying to find solutions in case, as we see, this conflict prolongs itself. Does not come to an end, and there's no end in sight, at least for now. We have to be looking at the safety and the security, and also allow me to add one additional point, which is the safeguards. We need to perform inspections there. Normally, it's 6 reactors, as I said, a lot of nuclear material there. So our safeguards inspectors need to go there. Would have needed to be there under normal circumstances. So now we have to see how to do that. Otherwise, we will lose what we call in the jargon the continuity of knowledge. We will not be able to know exactly what happened with the nuclear material, within a period of time. And this, of course, could lend itself to questions in the future. So lots of worries we have. We are working. We are in contact. We are talking to everybody. This is very important to maintain the channels of communication. And we are trying also to set up a physical operation of the IAEA there at different plants as soon as possible.
Sir, that you can continue this conversation with me in the future. This was such a valuable update for all of us. The IAEA Director General, Rafael Mariano Grossi, there on the situation in Russia and Ukraine. Your trading diary up next. Time now for your trading diary. What you need to be looking for: the UN General Assembly meeting at the top of the hour. Secretary Blinken holding a news conference at 11:15 Eastern, plus Fed speak from Bullard, Bosticks and Evans this afternoon. From New York City, for our audience worldwide, this was the countdown to the open. This is Bloomberg.